Well, we're starting to see where, like today, we're finally seeing the market move up without our beloved big tech. In fact, tech stocks are starting to roll over. Now, Apple, of course, and Tesla have already started to roll over. Right now, there's no more, they don't call it Magnificent Seven anymore. They're calling it the Fabulous Four. So, what I think is going to happen is this. I think we're going to get about a 15, 16% correction. Then they're going to rally it right back up. But we're close to a 15, 16% correction because the rally we've been in since October of 2023, we're up now about 28%, 26, 28%. So when you get a rally about 30% and there's no corrections, and the valuations get so high, all of a sudden the big institutions, they start cutting back on buying. And that's what we're seeing now. The buyers that are in there now are the tourists, the people who missed this whole rally from October up to where we are now, this whole 28% rally. Matter of fact, they missed the whole 15-year rally we've had from 2009. So now they're in what we call stage 3 pricing, which is where you hit the top, and this is where it gets really dangerous. And this where it can either turn into a correction first with a big crash later, or you get, again, a total crash now. And what you have to watch is when the tourists are starting to buy, when you're on stage 3 pricing, when you're topping out, watch the volume. If the volume is going up in the market, and what you're seeing is the pricing, okay, is not going up, but you see volume going up. What's that mean? Well, what's happening is the big institutions are dumping their stocks, okay, and the volume is coming from the tourists who missed the whole thing and now are jumping at the very top, just like they did in 1929, just like they did in 1987, the dot-com, the housing-com, they always jump in very late. So keep your eye on the volume. If you see big volume but pricing aren't going up, then you know you're in for a crash, okay? But I don't think that's going to happen immediately, okay, because we got this election going on, and they're going to try to do everything they can to keep this running. But I think, again, right here, let me show you. I think we're going to get, here we are right now, when we've gone up about 28% and no correction yet. So I think we'll get a little correction, and then they're going to rally it back up off that correction. So it may pull back right about here, rally it up, and that's where we're going to have to see what's going to happen. That'll probably be as we're into the summer, okay, is can it go beyond this point? If they rally, if it pulls back, then rallies up, that's the test right here when they rally it back up. If it can't make it, then it'll turn around and it'll take out this low, and you'll get a, like we do all crashes, 70%, 80%, but that's where we are now. Right now, just keep in mind we're going to get a correction and then a rally. All right. So, but the whole crash is going to come from, everybody say how we got earnings, right? That's insane. This rally has nothing to do with earnings. That's not why it's going up. This rally is going up because since 2008, 2009, we have a market that's been driven by debt, an economy that's been driven by debt. We doubled our debt from $9 trillion in 2008 to $34 trillion today. We doubled the money supply from $7 trillion to $14 trillion. So think about that. 7 to 14 trillion money supply, and our debt is insane. Now, why is it insane at 34 trillion? Because we can't pay it. Well, how do we know that? Because you measure if you can pay it through economic GDP. In other words, you look at your debt, the ratio of your debt to economic growth. If your debt ratio is more than 60%, you can't pay your debt back, okay? And that's when our lenders, Japan and China, they start raising rates on us, then we're in real trouble. So we have a ratio of debt to economic growth of 124%. So everybody can tell me there's not going to be a crash. There's going to be a crash. And the crash is because we've been financed for 15 years. We've been not on fumes, but on money supply and on pure debt. And when you have debt like this, okay, when you grow an economy not on earnings, see, when you grow an economy on productivity and earnings, then there's no inflation, or the inflation's minimum. Again, if you grow an economy from productivity like we always used to, and earnings, productivity is down. We have massive inflation because we grew the economy on pure debt. Now listen to this. Remember Powell? I can't stand this guy. How he got this job, I don't know. He wouldn't even qualify. You know, he has no bookkeeper license. He's not a CPA. He's a lawyer. Lawyer running the Fed? What?
We think that rates were generally low during the pre-pandemic, post-global financial crisis era for reasons that are mostly, important, slow-moving, large things like demographics and productivity and that sort of thing.
What the hell is he talking about? He doesn't even know what he's talking about. That is a bunch of BS. Are you kidding? That's all gobbledygook jibber jabber. No. In 2009, when market crashed, remember what happened? Well, we got wiped out. About $8 trillion in equity in the market, gone. About another $8 trillion in housing equity, gone. 10 million people were out of 10 million people, their homes were in foreclosure. We had about 8 million people out of work. Obama takes over in 2009. He said, oh my God, how am I ever going to build this economy? This is worse than 1929. And if I do what we always do, we build an economy through what? Productivity, business investment. You take business investment and you put that money to new equipment, new machinery, IT, and that all comes together, right? Buying materials and so forth, and all of a sudden you're producing. And when you produce, that's when you grow a strong country, because you don't have the inflation. That's right. When you grow an economy from productivity, not from debt, you have very little inflation. That's when our country was great. Okay, and that's when we were leading the world, because we always grew our country on productivity. When Obama saw it, Bernanke says to him, look, I got an idea, boss. Here's what we can do. We can fool everybody. What we can do is this. Why don't we just print a whole bunch of money, and then we'll take that money and we'll go buy treasuries. And let's bring the treasury rate down from 5% down to less than 1%. So we can get the housing market going. But here, we're going to do something different. When we get that down, let's drop our Fed rate from 5% down to 0. That's the important one, boss. 5% to 0. Because now what we do is we take money and we go to the banks. We print more money, go to the banks and say to the banks, hey, because they're all broke, the banks didn't have any liquid, we're going to take your mortgage-backed securities, we're going to take your treasuries, and we're going to fill you up with cash. And they said, gee, I'd like that, sir, but our mortgage-backed securities and our treasuries are worth about 10 cents on the dollar. Don't worry about it. We're going to pay 100% on the dollar. Whoa! But you got to do us a favor. You don't use that money for productivity. Give it to the CEOs free. But it's for the purpose of buying their own shares to push the stock price up. Because with the stock price going up, most people believe the stock market identifies how healthy the economy is. People are going to feel good. Now, it's not true, but we don't care. People will love it. They start seeing the stock market going up. They'll start buying cars again, and we'll keep interest rates at 0, and we'll tell them a story. The only ones that, yes, we're only going to do this for about 8 months, and yes, the guys at the top are going to benefit at first, okay, because they're going to get the money, but it's all going to trickle down to you and bigger jobs, and you're going to get raises, and it's all a bunch of BS. That whole rally took off. So what did they do? They rallied the market by doubling our debt from, get this, 7 trillion, okay, to 34 trillion. Obama doubled it from about 8 trillion, to about 16 trillion. Doubled the debt. No productivity, just debt.
Yeah.
president comes in, Trump, he goes another 7 trillion. Now we went from 7 trillion to 34 trillion. We are so screwed because this whole economy and the whole stock market is not built on earnings or productivity. It's built on 34 trillion in debt. Debt. And that's why you are going to get a crash like 1929, 80%, or you're going to get like 1987, 65%, or same thing with the dot-com and a housing town. Those are real crashes, and you're telling us, and people are saying, well, there's not going to be a crash. Of course there's going to be a crash, but in the meantime, what's going to happen, we're going to first get a little correction right here, because this whole rally from October, from this 10% correction from October, we've had no correction. We haven't had a correction, and our earnings stink. You know how they tell us how earnings are so good? She said, earnings are great. Listen to this crap.
Earnings are done. They were great for the fourth quarter.
No, they weren't. The fourth quarter, if you take out the Magnificent Seven, the fourth quarter lost money. Lost money the fourth quarter. So she's lying. So what's going to happen is this. We're going to get a correction. It's only natural. Don't panic. It's only natural, okay? And she's going to pull back like this to either 16% or to 15% right here. Doesn't matter. Then they're going to rally it one more time. This will be right before the election. And then if it can't get above this area here on earnings and productivity, then you're going to get your 60, 70, 80% crash, like all the other crashes. That's what's going on. So remember, you can't have an economy just built on debt. It doesn't work. It just doesn't work. So what we're seeing now is a rotation. We have seen money rotate out of tech stocks. We bought the bank stocks. Okay, I had my members going to bank stocks when nobody wanted to look at J.P. Morgan. So when J.P. Morgan was going up, we rotated right here. Look, J.P. Morgan was going up like this, right? J.P. Morgan was going up. And what was happening with Apple? Apple was going down, right? All those tech stocks, about 4 of them were all starting to break. Right here, look, Apple was going down, and then we had Meta. Okay, Meta now is starting to go down, and then you got Google, right? It started to break apart, and so again, all we have left is Nvidia, and it's pulling back right now, and Amazon's pulling back, and so everything that's going on in the tech sector is starting to unwind. Okay, and so money's been going into the banks. Money's been going into our oils. This is where we've been. Look at our oils, all been our oils, and then we put money into gold. And gold is going to get better and better and better. You watch. Look how our gold, even today, even with the dollar going up, not down, look at our gold going up. So you can see a real rotation starting. So I think what we should do, or you should do, is what we've been doing here at the gang. We bought the bank stocks, we bought the energy stocks when nobody wanted them. Bank, energy, and gold. And now we have profited big from them, because we knew this day was coming of a rotation out of the tech stocks. Now we think the next opportunity is IWM, small mid-cap stocks. They'll start rotating out of these small mid-cap stocks. They've stayed behind. See how the spiders are right there? See how the spiders went up in the small mid-cap stocks? And remember, the small mid-cap stocks are your livelihood, is your small businesses. That's the backbone of the nation, right? So I think you're going to start seeing a lot of money coming out of your stocks like Apple, coming out of your stocks. Watch over here, Apple, coming out of Tesla, okay, and coming out of all these stocks, okay? And they're going to start rotating. They already rotated to the banks. They already rotated to the oils. But now I think they're going to start rotating to the golds and also to the small mid-cap stocks, which the ETF is IWM. Look, why don't you join the gang for 10 days? And I can spend some real quality time with you, okay, and really teach you how to invest in stocks, okay, and how to also protect yourself, learning how to sell short, which is easy to do. Okay, so the idea that there's never going to be a crash again, that tech stocks, AI craze, and every day what do they do? We're going to cut rates, cut rates, cut rates. That's what's been driving the market, right? We're going to cut, and AI. But truly, it hasn't been. What's been driving the market is massive debt. That this country is in deep trouble trying to pay this debt. Now, how do you know that? Because when you measure your ratio of debt to economic growth, it's got to be at 60%. And then you can prove to your lenders you can pay back your debt. We're at 124%. So what's happening now, our lenders like Japan and China are raising interest rates on us. That's going to kill us. There's no good news here, okay? This has all been masked. And who the worst president is? Obama. He should have never started this QE. In the end, it's going to bite us right in the butt. Okay, join the gang for 10 days free, okay? Let us help you understand the stock market, understand when to buy stocks and when to sell stocks short, and which stocks you should be in, okay? All right, I'll see you on the charts.